All right. Today is Sunday, the 28th of July. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Hope you're watching the Olympics. That's what everybody's talking about right now, which will take some action out of the stock market. So the talk is, hey, because of the Olympics, we might see a rebound next week. A legitimate rebound. But folks are really hyped up about this Olympics hosted in Paris. And I guess it is exciting because it is the first time a third world city gets to host the Olympics. But rest assured, this is going to be a trend because the next one will be in LA. You know, when everybody comes an hour late to every event because you're stuck in traffic. Good luck with that. But you're going to see good sights in LA like the homeless encampments, the smog and the traffic and all of that. Good experience. But everybody's talking about this opening ceremony and people didn't like it. Allegedly, it was too queer. I would not know because I didn't even bother watching the opening ceremony. And I'm not sure that I'm going to watch the Olympics altogether because watching the Olympics here in the US absolutely sucks. I don't know if our overseas viewers know this or not, but here in the good old USA, they show the games taped, so it's late. But somehow we have to pretend that it's happening live and be all excited about it because it's on prime time where they can sell ads. So you're not really watching the games in real time. That's number one. Number two, and I say that as an immigrant, Americans are so into themselves, if you're not aware. So all what they show is Team USA, and they cut everything else. They were showing the highlights of the women's soccer game with Germany, and the USA scores, and they show everybody cheering up and down and celebrating, and then, Germany scored the draw, but they don't show you nothing. I want to see the goal. They don't show you that. I don't know if this is still going on or not, but back in the day, watching the Olympics, say in Europe, for example, they show you the whole games, every team. Not here, though. So I'm skipping on the Olympics, unless, of course, there's something interesting like the women's volleyball game. I'll be interested in watch. But besides that, forget about it. I'm going to stick to the stock market. And my wife was saying, hey, do you want to watch the opening ceremony? I'm like, no, why would I bother? I'm sitting here in peace. I was actually watching the Food Network. That's the other thing, the other trend here. You guys know that. You play anything on Netflix right now, it doesn't work out because you need to be engaged, and we all have ADHD. You're looking at your phone, you're not really paying attention to what's going on in the program, you need to commit, and it's just, we can't do it anymore. And then something interesting happens in the show, and now you gotta rewind and catch up with what really happened before that. You can't really watch TV series anymore. Unless it's really, really good. So the new trend will be watching background stuff, where you can actually watch while you're playing on your phone and falling asleep on the couch. That's the new trend. So Netflix, if you're listening, stop wasting your money on new shows, hundreds of millions of dollars. Nobody's watching that shit anymore. You gotta invest in what we call filler, background kind of programs. What's better than the Food Network? I was watching Guy Fieri instead, stuffing his face in a sandwich. And it dawned on me, this motherfucker is the luckiest man alive. He gets paid hundreds of millions of dollars to travel the country and stuff his face in good food. Meanwhile, some of us are digging ditches for a living. So I realized when I die, I want to come back as Guy Fieri and travel the country, stuff my face in sandwiches, and make hundreds of millions of dollars. Because any other life scenario is really depressing. You'll work really hard and you're not going to even make a fraction of what that guy makes. And speaking of depression, it's going to get worse, folks. Because the only thing that was going on well in this economy was the stock market. You can just look at your stock portfolio and jerk off when you feel depressed. And it make you feel better. But now, even the stock market is coming down. And of course, it's coming down hand in hand with the possibility of Vice President Kamala Harris becoming president comes November. Now I would say, folks, if the stock market goes down another 20%, I will officially endorse Kamala Harris as the president of the United States. Full endorsement. But folks, this depression crisis in the country is getting worse. And now it's impacting the economy. Even the affluent, the rich kids, they're feeling depressed too. Matter of fact, they're so depressed they're not even drinking champagne anymore. LVMH says that the wine business took a 12% hit because people are too sad to buy champagne. Although not as sad as the folks who died in the shipwreck in the 19th century and left us 100 bottles of vintage champagne. Problem is, it makes you even sadder because you can't afford the regular champagne, you can't afford the vintage champagne for sure. But maybe if the Republicans win the elections, there's a way where you can actually make more money and maybe afford some champagne. According to the new vice presidential nominee in the Republican Party, J.D. Vance, he says we should give tax cuts and tax benefits to folks who have kids and tax the folks who don't have kids more. So you want to make more money? Have more kids. This is, of course, the most idiotic idea we've ever heard of. Some of us are responsible enough not to have kids. because you think your kids are going to preserve your legacy and make you happy and all of that, but you guys are not raising your kids well. Your kids are either spoiled brats, incapable of doing anything at all, or they become a bunch of entitled asshole bullies that we have to deal with, the rest of society. Because you parents, you call your kids buddy. No. So there's no buddy. There's no psychiatrist. It's a father-son relationship. And it stays that way until you're an adult and you're financially independent. Then you can do whatever hell you want. But folks don't discipline their kids anymore. Matter of fact, they actually can't discipline your kids anymore. Back in the day, there was a reliable child development tool. It's called the belt. It produced a decent generation of men. Respectful, good manners, and sure, the trauma had an impact, but it's an impact on fashion. They wore suspenders instead of belts. Why should we pay for other people's children? Speaking of trend, you got this new trend of fathers having kids way too late in life. Like Mick Jagger having kids in his 80s. Why does he get to have a tax break and have to pay more to make up for what he's not paying? By the way, happy birthday, Mick Jagger, 81 years old, same age as Biden. But the guy's jumping up and down in concerts, doing cocaine and bagging chicks quarter his age. It makes you question the whole health advice thing. They say you gotta eat healthy, eat vegetables, take multivitamins, and you'll live longer. Bullshit. The guy been doing coke and smoking cigarettes, drinking whiskey his whole life, and look at him. Matter of fact, the scientists now say that daily multivitamin supplements don't help you live longer. In fact, rather than living longer, otherwise healthy people who took daily multivitamins were slightly more likely, 4%, than non-users to die in the study period. The advice I got for you kids, stop being sad. Drink some champagne, do some drugs, party all night long, have an unhealthy diet. You'll live longer. But anyhow, folks, let's segue to the stock market here, and we'll keep the discussion in this video exclusive to the stock market action. When we talk about Mick Jagger and old corpses, the boomer kind of economy, it was a boomer kind of market this week. Because I know everybody's talking about the rotation to the IWM and the small caps and all of that. But guess what other cohort of stocks did pretty good? I mean, everybody's talking about the biggest drop in the NASDAQ since the year 2002. And the Magnificent Seven lost $2 trillion in value in about 2 weeks. But there was another cohort of stocks that have been actually doing pretty good. And that's the old school value/dividend paying stocks, the old boring kind of stocks. Look at the chart of AbbVie, for example, to the moon. You look at Bristol Myers, rising from the dead. Huge gains this week, one of the biggest gainers so far. LMT, Lockheed Martin, dividend paying value skyrocketing this week. And of course, we have more optimism for these defense contractors because we were deploying long-range missiles in Germany to shoot at Russia. Apparently, the folks who ruled the country from the Pentagon and all of that, the drug addicts, the sexual creeps, they have achieved all sorts of pleasure and now they're bored. They want to jerk off to something new. They want to jerk off to the pictures of nuclear bombs all over the place. So they want to start World War III. And that's going to be good for these defense value dividend paying stocks. Triple M, old school, value, trash, at least considered trash for a while. Look at this. Huge gains on Friday alone, up over 20% single day. You look at unloved Pfizer, again, trash stock, but old school, dividend paying, value kind of stock, now rising from the dead, moving higher. And if you look at the trend of hot, sexy Eli Lilly, down 9% for the week, and then you see Pfizer up. Something else is going on in the market here besides the rotation into the small caps and the dash for trash. Oh, the Fed is going to cut rates. Everything is going to be great. Let's buy the profitless companies. There's another cohort in the market who says, maybe rate cuts, whether they happen for the good reasons or the bad reasons, they're going to be pretty good for companies that actually have profits, that actually pay dividends. And that's where the opportunity is. Now, the debate will go on, and I'm going to sort it out for you. You have to go back to the last 2 videos, though, because we talked about the rotation in details, what's going to derail the rotation, the risk-on rotation, the risk-off rotation, the AI rotation, the rotation to the dumpster, and how all of these scenarios are going to play out. I'll give you more in this video, but I want you to think about 2 things. When we talk about rotation, is it really a rotation when you have the Magnificent Seven losing almost $2 trillion in about 2 weeks? Now, if it was a rotation that went all the way into the IWM, the small caps, then the small cap index, the Russell 2000, should have been up 100% in the last 2 weeks because the entire value of the IWM, the Russell 2000, is $2 trillion. So where did the money go if they're selling the Magnificent Seven to the tune of $2 trillion and the Russell 2000 adding only 10% worth of value, 200 billion. Where's the rest? The 1.8 trillion. Where did that money go? Think about that for a moment. The other thing I want you to think about is, unfortunately, a lot of you, let's say if you're 35 or under, you haven't seen a real market read. All what you've seen is the market that the Fed created in the aftermath of the financial crisis of 2009, which is every drop, every crisis that we have, the Fed fixes by intervening in the market. You haven't seen unwinding before. And there's this level of confidence, overconfidence, I should say, and cockiness about, hey, every dip that happens, you just buy, the stocks only go up. But you haven't seen what happens when the stock market falls out of love with certain stocks. When the market falls in love with a certain stock or certain cohort of stocks, we see bubbles and insanity, as we've seen in NVIDIA, for example. But when the market falls out of love, it becomes brutality. You see these stocks going down big, defying the boundaries. You think it's oversold, and it keeps going down over and over and over again. And I think you've seen some of that in 21 and 22, when the small cap stocks kept crashing. A lot of folks forget about that. You're about to see them in bigger stocks now. And take, for example, what happened to the stock Dexcom. This stock was so hot back in the late 2010s. We couldn't have enough of it. Then all of a sudden, this Friday, the stock goes down by more than 40% in a single day. The market can be really brutal when it falls out of love with certain stocks. And unfortunately, a lot of you haven't seen that, but you're about to. So think about that for a moment as we do the rotation analysis. Because this week, if you look at the dollar index, it all revolves around the dollar and bond yields. That's what the rotation is all about. This week, we got a flattish dollar. It didn't really move one way or the other in a significant way. But we've seen a drop in bond yields. Now, when that happens, we have to ask a good question, which is, was the drop in bond yields for good reasons or bad reasons? Good reasons meaning the Fed is going to cut rates because inflation is coming down. Bad reasons, we're cutting rates because we're getting recessionary data. Well, if that was the case, then we should have seen the dollar also going down as we begin to price in a recession and more intervention by the Fed. But the fact was the dollar is flattish, bond yields are down. And the other piece of evidence was, if you look at the 2-year yield in white and then the 30-year yield in orange, you can see that the 2-year, which is the pulse for the Fed policy, they have more control over the shorter end of the yield curve, not the longer meaning 10 to the 30. So when you see the 2 moving down by a bigger magnitude than 30, it shows you right away, and we go back to the month of July for illustration purposes. You can see that the 2 years down almost 8%, the 30-year yield is down about 3 to 4%. That tells us right away that we have a steepening of the yield curve. And it's happening because folks are thinking that, hey, the Fed is going to cut rates for the good reasons. They're done with inflation. They're going to begin cutting rates. If that is the thinking, of course, it's going to benefit what? The risk-on rotation, IWM, KRE, regional banks, the profitless companies, you know the deal. But it also benefits the risk-off rotation. As bond yields go down, it appreciates the value / the dividend-paying companies. But of course, these rotations happen at the expense of the AI mania. Not because, now that you thought about it a little bit, not because we're moving the money, the $2 trillion that we took out of the AI into the risk-on or risk-off rotation. No. A lot of that money is staying in cash. A lot of that money just transferring hands. But what's happening right now is the thinking of, well, we got the first hints that the Fed is about to pause. And we've seen the top in bond yields and the dollar, and then we've seen a pause. They stuck at a certain level, way too high for a lot of sectors of the economy. The thinking was that the companies who can withstand this high level of rates, even though the Fed is pausing, not hiking, would be the large cap companies with a lot of cash in the books. The Mag 7, the AI mania. If we have a different dynamic now, with yields going down, and perhaps the dollar also going down, then the thinking goes, maybe we've overdone it with the inflows into the big caps and the AI mania. We need to take that out and then rotate some of that money into the newer trade, the fresher trade of risk-on rotation or risk-off rotation, depending on what you see in your economic outlook. So that's what's really going on. The question now becomes, where do we go from here? We have a critical week coming, folks. We have the FOMC. Whatever the Fed does will have an impact. Now, the consensus is the Fed is not going to cut rates in July. The Fed will wait till September. Frankly speaking, I want the Fed to cut rates next week. Not because I think, the economy is falling apart and the Fed has to cut to rescue the economy and all of that. But I want folks to see the duality of the risk. I want them to see, because there's talk, of course, that, hey, Fed, you got to cut rates right now, because if you don't do it right now, the economy will deteriorate even more. So this is the sweet spot to do it. And that talk, of course, comes from a lot of perma-pumpers. But seldom in the conversation the talk of what happens in the duality of the risk. That if you address one risk, which is the recession risk, what happens to the inflation risk? I want folks to see that. I want them to see that the moment the Fed begins cutting rates, you'll see inflation moving back up. That's why I want the Fed to cut rates this coming week. But regarding the stock market activities, the tone and the narrative really matters. Is the Fed cutting rates because of fear of recession, or are they cutting rates because inflation has been defeated, mission accomplished? It makes a lot of difference, because if you look at fear of recession, we have plenty of evidence to that. For example, if you looked at any earnings from consumer-related companies, these were awful. I mean, you look at Tesla, it dropped down 45% net income year on year. It shows that the market is oversaturated and the consumer is getting weaker to buy new EVs, and the confirmation came from GM and Ford. I mean, you look at Ford, the biggest drop since 2008, because these EVs, not reliable, cost a lot of money, and folks don't have the spending power to buy these EVs. It's not just EVs, folks. You look at Southwest, profit down 46%. You look at Capital One, profit down 61%. You look at UPS, the biggest drop in the company's history, because package volumes down, revenues down, expenses up, consumer getting weaker. But inflation is sticking. We have stagflation in the economy, and it's impacting these companies. Even the affluent consumer, we got warnings from Burberry before, but now even Gucci, hitting 7-year low after a weak forecast. They say because of drop on China sales. We all got it. China's weaker right now. It is already in a recession. But the weakness is also showing up in other territories. The consumer is getting weaker here, in Europe, all over the place. And because of stagflation, we got the news this Friday that U.S. consumer sentiment falls to 8-month low on high prices. So there is evidence, if the Fed wants to cut rates because of fear of recession, there is evidence that they can do that. And even somebody like Bill Dudley, who I would consider a rational former member of the Fed, you got to remember he kept saying that the Fed is not doing enough, they should hike rates more, yada, yada, yada. Now he flip-flopped all of a sudden, and it made headlines in the market this week. He said even September may be too late for a rate cut to swing the U.S. economy out of a recession. As if Bill Dudley is saying, look, based on the evidence that we got so far, we're heading into a recession, no doubt about it. And if the Fed cuts rates by September, it'll be too late. As if he's suggesting that the Fed should do it now in this upcoming meeting. So suppose that happens. Suppose the Fed cuts rates because fear of recession. Of course, the Fed is not going to tell you, hey, we're cutting rates because we're afraid of a recession. Not going to say that. But the market will read between lines in the statements in the conference. If it comes out with this conclusion that the Fed is cutting rates because of fear of recession, what do you think will happen to the dollar and bond yields? They'll go down because the Fed is easing policy now. But when it comes to the rotation, the risk-on rotation, the IWM, the profitless companies, the regional banks, would actually reverse and trend down, because we're cutting rates for the wrong reasons. On the other hand, the risk-off rotation, the dividend-paying, the value stocks could actually gain momentum from that point on, because with yields going down, even if it is for the wrong reasons, so long as we're not buying bonds and the dollar together, meaning dollar and bond yields go down together, then money has to go somewhere within the market, and it will favor the value/dividend-paying stocks. Now, suppose the Fed cuts rates this meeting, but the market reads it as, oh, they're cutting rates because they're confident that they have defeated inflation. Then what happens? Dollar continues to go down, bond yields continue to go down. It'll be good for the rotation, doesn't matter which one you choose. But of course, it'll be more favorable toward the risk-on rotation. The IWM will make a higher high, the KRE regional banks will do the same, the home builders, the real estate sector, the biotech sector, the retail sector, because everybody will assume that, okay, the worst in the economy is already behind us, and the Fed will cut rates, this is going to be good for the economy. What happens, though, which is at least right now the consensus, that the Fed hold rates and they don't cut. The question now becomes, and they're kind of correlated, but it makes a bit of difference. Are they holding rates because they need to see more? They need to see another positive, in other words, negative inflation reading? Because if we got negative inflation reading, that means it's positive for the Fed and for the economy, that inflation is going down. Or are they holding rates because they're afraid that if they cut, inflation will come back up, that the inflation risk is not defeated quite yet? Again, they're kind of similar, but they make a difference. Need to see more is a little more positive than, oh, we're worried about inflation risk. In any case, the impact will pretty much be the same. The dollar and bond yields will rebound higher, because right now we've already priced in a rate cut, a 25 basis points rate cut. If that's not going to happen in July, you'll see the dollar and bond yields going higher. Is there a case that the Fed will hold rates? Absolutely. And it comes from Vanguard, the biggest one of them all. Vanguard offers unexpected Fed interest rate forecast. This was shocking because everybody said, oh, the Fed is going to cut rates, no doubt about it. If it's not July, it's September. Vanguard disagrees. Economists at Vanguard see things a bit differently. They anticipate the Fed will leave its federal funds rate target of 5.25% to 5.5% through year end. That is unchanged from the prior forecast. The Fed funds rate is charged on overnight interbank loans. Continued economic growth, labor momentum, and stubborn inflation are likely to leave the Fed without the confidence it needs to cut rates this year. The economists from Vanguard wrote in the commentary. So again, there is a case that the Fed is not going to do it in July, and they might say that, hey, we need to see more before we do September. If that is the case, again, we know the dollar and bond yields will go higher. That's going to be bad for any rotation, risk off or risk on, but specifically the risk on. The IWM, KRE, XHB, all of these rate-sensitive ETFs and stocks will go down tremendously. They will pull back in a big way. The risk-off rotation will give up some ground and pull back too, because now bond yields are going higher. The question now becomes, where would the money go in that scenario if the rotation is not working out? It depends on tech earnings. So we have plenty of them coming out this week. If we have a savior, and by the way, Alphabet earnings were pretty good, but the problem is we see peak in the bottom line, peak in the growth and revenue, and the stock price already priced in a romanticized story, an AI story. And all of a sudden the earnings report comes out good, but says, hey, the stock price doesn't make sense. So there is a correction. The question now becomes, do we have earnings from Apple or Meta or Amazon, any savior that can come out and say, look, we have growth, and growth is still going on. It's not peaking, it's not stalling. If that is the case, then tech earnings will come out good, and we will see a rotation to AI/big cap tech. We'll see buying the dip with these names. If tech earnings come out bad, though, then in that scenario, we have a rotation to the dumpster. Everything gets sold off. The other challenge, of course, that comes after the FOMC, not this upcoming week, but the week after. I've said this before repeatedly in this program, that we're going to have a day just like Black Friday back in the year 2000. But the NASDAQ went down by more than 10% in a single day. And the catalyst behind that was a not-so-friendly inflation reading that told us, hey, wait a minute here, the Fed is not going to cut rates. And I think we'll have one of those. Now, is it going to come after a Fed rate cut in July, or will it come out after a Fed hold? Makes a difference, but we're not going to go ahead of ourselves here. But just keep that in mind, that the CPI next reading will be really important. If there is a rebound in inflation, it's going to change a lot of things, and we might see a shock kind of reaction in the market. But one step at a time. This week, we only have the FOMC as the most immediate catalyst. We just played and gamed some scenarios on how the rotation works out. Now, the other thing I want to show you is a lot of folks brought this up to my attention. Hey, what do you think about the rotation to international equities? Since American equities has been outperforming for years now, will we see a rotation into international equities? The answer is absolutely, without a doubt. But I think that will happen later when the recession becomes more evident and the Fed begins cutting rates aggressively and easing the policy aggressively, aka devaluing the dollar aggressively. Then I think that we'll see international equities outperforming U.S. equities. Before we move on, I want to address this point that we talked about in the last video for the members, because we got the drop and we talked about the drop and the indicators step by step. I showed you how to look at the waves in the MACD. And in Discord, I said, look, the wave in the MACD and the hourly will lead us to a correction. So we're going to go down. There is a correction coming. I explained to you how to look at the individual components of the S&P 500, the XLK, the IGV, the individual tech names, the XLF, financials. We did the analysis one by one. If we see them weakening altogether, the evidence adds up that we're ready for a correction. Unfortunately, a lot of you are afraid and didn't really take the shot on a trade for a correction. Now, a lot of the questions that I got this week relate to the psychology pitfalls, and we discussed them in the last video, but I'm going to give you an update. Pitfall number 1. It says, I missed on the drop. I think I should bet for a rebound because the market is oversold. I wasn't available Thursday and Friday, but Thursday we got a drop again in the market. And then came a big rebound. From the lows, it was a big rebound. The question is, did you buy that rebound? Most likely answer is no, you did not. And if you did, during the last hour when the market reversed back to the downside, you probably got scared and you switched to puts or you abandoned your rebound plays. The other psychology pitfall was, I think I should wait for a rebound to enter short trades and positions. Okay, Thursday we got a nice rebound. Did you enter the shorts during that rebound? Most likely answer is no. You got too scared because you thought, oh, this is a big rebound. We're going to recover again. I've seen this movie a million times before. and you did not short, even though in the last hour of the day, the market reversed back down. You got another rebound Friday. Did you short? Most likely answer is you did not. The problem again with this psychology pitfall, be it the first one or the second one, is the lack of decision making, the lack of confidence. And if you suffer from that, then trading the stock market is not for you. Maybe investing in the index, just buy the index and hold on to it. Maybe that's the kind of style of investing that you got, but trading the stock market is not for you. Trading the stock market requires balls, requires analysis. You look at the evidence, the cumulative evidence. And if things begin to add up to one way or the other, you gotta take the shot. You gotta take the risk. And if you can't do that, it's just not meant for you. And on Friday in the morning brief, I gave you an easy guideline. If you don't have stake in the game, if you're not involved in the long side or the short side one way or the other, and you're waiting for an entry, either a rebound play or a continuation of the correction, I gave you a guideline. Looking at the NASDAQ futures, the hourly chart, if we break above 19,390.5, and we cross in the MACD above the zero line, meaning into positive territory, then you got your validation that we have a rebound play. If, on the other hand, we fail to cross in the MACD indicator above the zero line and we violate 19,000 as support, then you got your validation that we have another leg down in this correction and you can play it. Here's the update at the time of the recording of this video. We don't have any confirmation one way or the other, but now you know what to look at. If you're not decisive, you got to set some guidelines to make the decision making a little easier for you. And the last thing I want to comment on, because a lot of you asked me about this, what do you think about it, Maverick? And I said, look, the news about Andrew Long being accused by the SEC of fraud and market manipulation. Now, look, this guy's a piece of shit. Everybody knows that. He made no friends. That's his fault. So we're not going to feel sorry for him. But listen to this. Federal prosecutors and securities regulators in Los Angeles announced charges Friday against prominent stock analyst Andrew Left, alleging he made millions of dollars of ill-gotten gains by making public comments to manipulate stock prices of companies such as Nvidia, Tesla, and Facebook, while also investing in the companies. We call this standard procedure in Wall Street. So the insiders, be it the owners of these stocks, the CEOs of the companies, or the funds who invest in these companies, they send their dog analysts from CNBC and the likes. I mean, the whole point of CNBC is to pump stocks, is to convince the public to buy stocks. That's what they do all day long. Of course, the insiders pay the analysts go on TV to pimp stocks, so you can buy them and lift the equity price higher, so the insiders can cash out and become liquid rich. When was that wrong or a problem in Wall Street? If you're gonna pick on this guy for doing this, then you gotta put all of Wall Street behind bars. So this is all bullshit. We know that the SEC been in a coma. This is the golden age of fraud. It's been going on. You have Elon Musk pumping stocks. You have politicians pumping stocks. I mean, when Trump this week says don't sell your Bitcoin, isn't he manipulating the price higher? Influencers. I mean, you have all kind of manipulation that happens every day. It's standard procedure right now. And the SEC was watching while all of that happened. So this is just a bullshit case for the SEC to say, hey, folks, we're not in a coma. We woke up. There's a cop on the beat. Give me a break. Anyhow, let's expand this conversation here, folks, and look at the market activities for the week that was. We begin with the closing of the indices on Friday, and here we go. The diamonds in the green by 654.27 points, or a gain of 1.64%. Now, the Dow Jones, I would say it's not really a perfect correlation, but it is a representative of the risk-off rotation, the value dividend kind of rotation. Then you got the NASDAQ. That's the AI mania, also up by 176.16 points, or a gain of 1.03%. The SPDR S&P 500 combines both, also in the green, 59.88 points, or a gain of 1.11%. And the Russell 2000 small caps, aka risk-off rotation, leading the way with gains of 3.65 points, or a gain of 1.65%. What is the point here from Friday's action? It was a drop across the board, a lot of puts been bought ahead of time, a lot of profits been taken off the table from these puts Friday, and we see also the market maker exercising some pain by moving the tape higher. So the expiration of options had a lot to do with Friday's activities. Now, as we segue to a new week, anticipation by the Fed policy becomes dominant. Here are the performances of sectors on Friday, all in the green, led by, once again, yield-sensitive risk-on rotation, real estate. You got industrials, metals, those are the top three, but every sector was in the green. It was an inclusive, algorithmic, mechanical kind of rebound related to options. You look at the week, though. Let's start with the laggards. The laggards, the AI mania in comm services, technology, consumer cyclicals. I mean, Tesla has a huge weight along with Amazon in this category, so they dragged it down. But look at the gainers. Was it any of the risk-on rotation sectors? Not really. It was the risk-off. It was the defensive, dividend/value kind of sectors. We're talking about utilities. We're talking about healthcare. And industrials come at number 3, but the major contributors were actually value/dividend paying stocks, not the construction mania bubble kind of stocks. You look at the breadth all in all, the NYSE 83% advancing versus 16% declining. The NASDAQ 68% advancing versus 28% declining. And we've been seeing, even though the NASDAQ been going down, we've been seeing more new 52-week highs versus 52-week lows. So the breadth underneath it all was actually getting better. The problem is the weight. We have the weight problem. The big guys go down, they drag everything down, at least on paper, when it comes to the indices. Look, for example, at the heat map on Friday. An inclusive rebound across the board. You can pick on certain names that went down. Google, of course, because of the news from ChatGPT, introducing a search engine. And of course, Eli Lilly, NVO, the Ozempic mania, I think it's done for now. The attention right now is shifting toward the pills. So you'll see Amgen, you'll see Pfizer appreciating more. And on top of that, of course, we got the news that scientists now making new discoveries leading to the next generation Ozempic. And maybe Eli Lilly's falling behind. So I think for all intents and purposes, the Ozempic mania, we've already seen a top in that. And from this point on, we'll see deflation and redistribution. So you see Eli Lilly going down, NVO going down. But other names, specifically those involved in the pill, will begin to gain momentum. So rotation within healthcare. Pay attention because this is happening and folks are not talking about it. Now contrast the heat map with the weekly heat map. The picture is clear. The passive investing bubble in the big caps, Google, Meta, Apple, Microsoft, Amazon, all of them are down for the week. If you look at the AI mania in chips, most of them are down for the week. The only name that went up was the value TXN Texas, but the rest of them down, led of course by the big kahuna, NVIDIA. The Ozempic mania, not so hot so, Eli Lilly down, NVO down, and of course you have Tesla. This was a gamma squeeze based on the robotaxi promise. Comes the earnings report. Here we go. We're back talking about margins and we're delaying the robotaxis. So Tesla goes down by 8%. Of course, earnings had an impact. So you see names like UPS down, Honeywell down, Waste Management down for the week. Even in banks, you see Visa down, Bank of America down, but then you see JPM and Wells Fargo going up. We got some news about Bank of America with Warren Buffett cutting his stake. So all of this has an impact, but the general theme, folks, the names that advanced this week, I mean, look at AbbVie, look at J&J, Thermo Fisher, Donner, Bristol Myers in healthcare. Look, for example, at the value rotation in industrials, like Raytheon RTX, like Lockheed Martin, LMT. These names went higher. They pay a dividend, did pretty good. Triple M, same story. You look at the defensive /dividend paying /value utilities. Those are moving higher. In consumer staples, names that pay dividend and offer value like Philip Morris, like PepsiCo, Coca-Cola, all in the green for the week. And then, of course, you have the risk-on rotation. You see them in the home builders, Lennar, D.R. Horton. You see them in some of the construction names in industrials. You see them, of course, in some biotech names that went higher this week. You see them in the regional banks. You see them in names like Blackstone in asset management. So it was a rotation kind of week. And now the question becomes, will the Fed FOMC announcement and the conference that follows, will it initiate a rotation back to AI if they hold rates? Or will it initiate a rotation to the dumpster? We talked about these scenarios in details. Or will the Fed actually do it and cut rates? And in that case, will we again see more of the same that we're seeing right here of the rotation, or will we distinguish between the rotations and favor value over the risk-on rotation? These are all important things to keep in mind. We talked about them in details. The heat map for the ETFs for the week. Again, no major movement in bonds. The TLT was up a tick, but it was good enough to keep the rotation into risk-on going. The IWM, the biggest gainer for the week, led of course by the KRE regional banks, the XHB home builders, ITB construction, XRT retail, XBI profitless companies, and biotech. But you see value, mid-caps did pretty good. The sector that suffered was large cap growth, IWF, VUG. So again, the rotation is clear. My hunch though, I mean, you look at the XLU versus the KRE. Scott, obviously KRE regional banks outperformed the XLU. What do we do this week, this upcoming week? I think as more data rolls in, the risk-on rotation will be out of favor. The risk-off rotation will be in favor. Looking at commodities for Friday, what do we see here? A drop in crude oil, although gasoline RBOB was up about 1%, so we've seen the refiners doing pretty good on Friday, Marathon and Valero. But crude oil down, that's a warning sign, along with copper going down, of course, that maybe we're seeing some economic weakness because the dollar did not move higher by a lot to trigger a downward movement in crude oil. So commodities saying a different story than the stock market. Commodities may be sensing a recession problem, while we see the stock market sensing a cutting rates for the good reason, optimism. This will be sorted out this week by the FOMC. We see big declines in grains. Gold, though, made a comeback in metals Friday, so this is really interesting. What is the message from gold? Is it anticipating the dollar to go down and the Fed cutting rates as soon as this meeting, or is gold just being a reserve for safety when folks are not sure where to rotate to? The answer to that, of course, coming this week, which makes it a critical week to watch. Forget about the Olympics here, folks. Look at the weekly performances. What do we see here? Rough rice in the futures, the VIX, soybean meal, cocoa, lean hogs, live cattle leading the gains. And the laggards led by nat gas, soybean oil, oats, obviously the NASDAQ, the Nikkei because the yen went higher, cotton, wheat, silver, coffee, the S&P. You see all of them moving to the downside for the week. We'll look at the options market, the big casino. What do we see here on Friday? The volume down across the board because folks are not programmed to trade when the market is not going up. Everybody's programmed to buy calls. So we see the volume go down. We have corrections in the market. But look at the ratio of puts versus call. It is increasing into the 40s in certain names. And that tells us right away that maybe we're getting closer and closer for at least a short-term rebound as we see excessiveness in buying the puts, specifically with the Johnny-come-latelys with shorter expiration dates. But one name I will continue to follow really carefully is NVIDIA. And the reason is NVIDIA, the IV rank, and you've seen this, we've been talking about it for weeks now, folks, that the IV rank was really cheap in the 40s, 50s. So there is a big move coming in NVIDIA that will lead the IV rank to 100. The question is, will it be up or down? Right now, the answer is down. And if the IV rank's sitting at, let's say, 80 right now, and it has more to go to reach 100 or closer to 100, then we have more steeper declines in NVIDIA. So this is the number one name that I'm watching. We have to look at the technicals, and we have to look at if we have another target and an increase in the IV rank. How far will we go? Because if NVIDIA goes down, it takes everything down with it. We see another ugly week for the indices. Looking at the flows on Friday, the bullish flows, bearish flows on the buy side, they're buying calls on Meta, Microsoft, Apple, Coinbase, NVIDIA, GDX gold miners, Boeing. They bought puts on the indices per usual, the SPX, the SPY, on bonds, on SMMT, on PRCT. We'll look at these trades in a minute. On Supermicro and Tesla. We'll look at the flows for the sell side. Bullish flows, meaning they're closing puts. On DXCM, the name that went down 40% on Friday, you have names like the indices, NVDL, the leveraged index for NVIDIA, bullish one. They're closing the puts on that, so maybe they're betting for a rebound in NVIDIA. You see them closing puts on Snowflake or Nike, but they're closing calls on Coinbase, on gold futures, the SPY, IWM, Blackstone, Micron. You can look at these moves. For example, if you want to look at closing the calls in Blackstone, BX, what does that mean? Are they betting that yields are going to rebound and we see Blackstone yield sensitive going down? Perhaps. But the sell side is only telling you what folks are booking in profits. Somebody is booking the calls, closing the calls, booking the profits. The question now becomes, are they opening a put on top of that? Out of the money. If that is the case, then yes, it strengthens the case that the stock is going down. Similarly, when you see it says bullish flows here on the sell side, because somebody closed puts on CMG. Let's take that as an example, Chipotle. Does that mean that the stock is going higher? Only if we see bullish flows on the buy side. Somebody buying out of the money calls on CMG, closing the puts, buying the calls. It adds to the evidence that the stock is going higher. This is, of course, the beauty of looking at these flows and studying them. So don't make a judgment based on these flows until you study both sides, the sell side and the buy side, on whatever stock you're interested, whatever ticker you're interested in trading. Let's look at the unusual activities that took place in the options market on Friday. Here we have a diagonal call spread for the Qs betting on a rebound, but the details are really interesting. They bought the 485 calls. The expiration date September 20th, and they sold the 490 calls for a shorter expiration date August 16th, spending about $3 million on this trade. What is the point and the goal from this trade? They see a recovery in the Qs. Come September, they're confident that we're going to trade above 485 again, but they think that the road will be more difficult, that we could see more declines in the Qs or more stalling in the Qs to the point where we're not trading above 490 by August. So it's going to be a slow recovery, but by September, we'll be above 485. 485, yet we're not going to be above 490 by August. Bullish, but not the most bullish kind of trade. Here we have another highly unusual one for you. For JPM, somebody bought the 215 calls, the expiration date October 18th, spending a little over $1.5 million. Not too far out of the money, but the bet is big. The question now becomes, of course, if we have the Fed, for example, not cutting rates in July, and maybe not being too enthusiastic about the September cut, but we see the KRE going down regional banks, where do you think those flows will go to? They'll probably go back to JP Morgan. Maybe this is the idea behind the trade. Then we have FND. On the bearish side, somebody bought the puts, 95 puts, expiration date August 16th, spending about $3 million on those. This is really interesting because we have an earnings report coming out soon. You look at the weekly chart for FND. We have a trend line. Can we at least go down and revisit the trend line, or maybe breach the trend line when the report comes out? This is at least what the trader is betting on. Then we have sort of a timing play here on Summit Therapeutics, biotech company that exploded higher recently. Somebody bought the 10 puts, spending about $1 million for those with the expiration date of September 20th. Now here's the chart for you. In about a couple of months, the stock exploded higher by more than 400%. The question is, we have an earnings report coming out really soon. I think the trader wants to time it, but they're not really sure if it's going to go down tomorrow or next week, but they're sure it's going to go down by the expiration date of September. It'll be way below 10, and maybe the catalyst will be earnings. And this is why they bought the 10 puts, and they went all the way to September. So they don't really care if the stock goes higher another 10% comes Monday. They're confident once the report comes out, the stock will be down below 10 comes the expiration date of September. Here we have another one for PRCT. This is for ProCert Biorobotics. As you can see on the daily chart, maybe we're seeing sort of a double top formation. We've broken support at around 63.26, maybe down we go. And this is why the trader here been buying these 60 puts. The expiration date August 16th, spending about $1 million in those. Now let's segue and do some charts and then wrap it up, folks. We begin with the SPY, an hourly chart. What do we see here? It looks as a bottoming attempt, that we're trying to find some footing, that perhaps a lot of the puts, a lot of the shorts are being covered. But we're not seeing folks hopping in with confidence and buying the dip, betting for a rebound. But we know for now, looking at the hourly MACD, where is the wave leading? The wave is leading toward a rebound. We're not talking about a recovery yet, a recovery once we cross the zero line. But it looks that we have a rebound. Can we have a rebound and close some gaps or retest some prior resistance levels such as 550? That is a possibility for now, and is the highest possibility than a drop right off the gate. Here's the problem though. If we look at the daily chart for the E-mini futures, what do we see here? You got a drop, you see the MACD, the wave is now turning negative, and you see the RSI not oversold, so we could have more juice to come in this drop here. We're below the trend line. So the thinking goes, if we cross below the zero line, we're probably going to have a confirmation that the wave ended, and we will have steeper declines as we've seen before when we crossed the zero line in the MACD daily indicator. But usually what happens, once we touch the zero line, there's an attempt for a recovery. There's an attempt for a rebound. Suppose we get that. The other problem that we got is we could be in a Christopher Nolan pattern, an ABC pattern within an ABC pattern. So we got the inverse ABC right away. We could have another inverse ABC after our initial rebound, which would be the B leg that we're in right now. So the market is still risky in suggesting that we could have more juice to this correction that we've began. I would plug in the Bollinger Bands and the daily moving averages. You got the 20 in white. That's not important right now. What's important is the 50 in blue. If we lose the 50 again, then it will add more to the evidence that yes, we are indeed in an inverse ABC pattern. Are we going lower? How far can we go? Now we plug the Fibonacci retracement lines, but we see that we are at support at the 38.20% retracement. So we're rebounding from a lower Bollinger Bands and a Fibonacci support. Makes sense. The problem is if we fail right now at this point, and we begin to trend down, then it suggests that we're going to go to the 50 line in or around 5,342.5. And then we'll probably see an oversold RSI and MACD, and we can talk about maybe about more sustainable rebound. When do we confirm that we're out of the woods and the correction is over? Once we close above the top of the breakdown candle. That is 5,585. You got to write these notes, folks. They're not going to send you invitation cards. Hey, we're going down again or we're going up again. You got to take the risk. After looking at these confirmation lines, when we look at the Q's hourly chart, what do we see here? We played the head and shoulder pattern, and now we're finding some support in or around 460.58. That's my number, at least. I'd love to think that we're finding support right there. In reality, we're finding support a little below. But you look at the wave in the hourly MACD. What are the odds here? Do we drop again, maybe, but it's not going to be a steeper drop. The odds right now say that we have a rebound. We're not recovering yet until we cross above the zero line in the MACD. We're not there yet. We could have just another rebound as we've seen before, and that rebound produced a gain of about 2%, then we flush down again. So this could be the case, that we get a little bit of a rebound, then we flush down again. Because you look at the daily chart for the NASDAQ futures, we've broken the trend in a big way. We're finding support at the obvious number, the 19,000, but look at the behavior of the daily MACD on the NASDAQ futures. It's already in bearish territory. It already crossed the zero line. So it is the leading indicator for the S&P 500, and if it begins to find some footing, then so will the S&P. If it continues to go down, it will drag the S&P down with it. Can we argue that we are, again, the Christopher Nolan pattern, the inverse ABC within an inverse ABC? Yes, we got one, and it could be the second one coming. We see the B leg, maybe Monday, Tuesday, then we get a bad earnings report or a bad outcome from the FOMC, and we go in a C leg further to the downside. That is the possibility, highest possibility right now on the daily chart. But we have to assess it from different perspectives. We clean up the chart, plug in the Bollinger Bands, the moving averages. We have to support the lower Bollinger Bands. We're getting a rebound. Makes sense. But we're not going to begin to talk about, okay, we're not in an inverse ABC pattern unless we close above the 50 daily moving average, sitting right now in or around 19,600. The other thing you got to keep in mind is the 100 daily moving average. Still in blue, we moved it down, so from the 50 to the 100. When do you have confirmation that we are indeed in an inverse ABC leg and the B leg is over? C leg is ongoing right now. Once we break below the 100 days moving average, you got to write that down. If we do it, let's plug our Fibonacci retracement lines. How far can we go? How about the 61.80 retracement line? That'll be in or around 18,591.5. And then we'll see what happens. We might be oversold enough to sustain a rebound. We look at the NDX weekly chart. If you look at the waves in the MACD and the weekly chart, we're just beginning the correction. And that's what folks have to keep in mind. If it is a benign correction, you'll see the daily recovering first, moving above the zero line. And then you'll see the weekly MACD indicator moving back up again, and we'll look at this as yet another correction that did not end the bullish wave. I would say the odds right now that this wave ends and we go down to the zero line or reach below that, ending the bullish wave that began, let's say, in the fourth quarter of last year. And that could produce a steeper decline, but one step at a time. Daily confirmations first, then you got the Fibonacci on the weekly, which is 18,271.89. You lose that, you can take another swipe at the NDX all the way down, 16,775.34. What do we do with the IWM daily chart? It is still not above the highs that it printed last week. It's been yo-yoing back and forth. We've seen on days when yields go higher, the IWM goes down. On days when yields go down, we see the IWM coming back up. I think the Fed will dictate what happens in the IWM right now. So we can't do anything without having the Fed out of the way. We can play a lotto before the FOMC, and that would be probably using the KRE as a proxy. We'll talk about that when we get there. For now, here's the Dixie daily chart. Important week for the dollar. It is holding on to support, holding on to perhaps an inverse head and shoulder pattern. You look at the wave in the daily MACD. It looks as we are ready to move from bearish to bullish. Why would we do that? Maybe because the Fed is not going to cut rates. And the Fed will say, we'll see about September. If the day comes out collaborative, yeah, we'll do it. If not, we'll continue to hold. If that is the case, dollar is going to go higher. It's going to catch a bid. Would that be good for the old man gold? I don't think so. I think that gold, if the dollar goes higher again, it could be also just like the stock market in a Christopher Nolan pattern of an inverse ABC within an inverse ABC. And we make a move all the way down to the lower Bollinger Bands. That'd be a tragedy for gold because we were so hopeful that once we have the break above the triple top, that we're on to the races. But it depends on the dollar going down. The SLV got whacked Friday's session, and I said before, you want to stick to the precious metals, stick with gold, not silver. Silver is more sensitive to the dollar, and even the rumors of the dollar going higher. Gold is more resilient because gold is not traded as much as silver. So you have stronger hands in gold than the SLV silver. We'll look at crude oil futures daily chart. What do we have here? Looking at the Fibonacci perspective, we're below 78.15, so not good for crude here. And we're forming a bear flag pattern. If the buyers don't show up, the bear flag is going to play out. We'll be down at about 74.16, the next retracement line. We have to look at it from a different perspective. The Bollinger Bands and the moving averages. We have supported the lower Bollinger Bands, and we could be in the process of gathering energy. And once the buyers finally show up, we'll move higher. So we'll keep an open mind here that crude oil could move higher. And I think it would move higher if the Fed indeed cuts rates this upcoming meeting. So we'll keep an open mind, but it is a process of Crude oil saying, hey, I'm done with the first leg of the sell-off. Any buyers here? I'm ready to rebound. If you guys don't show up, I'm going to take the next leg down. That's what the chart of crude oil is saying right now. But it goes hand in hand with copper, if there's a message, because copper is down about 22% since the top about a few months ago. Now, when copper collapses to this magnitude, it's not saying good things about the economy, so keep that in mind. With that being said, look at a stock like ExxonMobil. Despite the fact that crude oil been going down, ExxonMobil been doing pretty good, moving higher. Why? Because it is value, dividend paying. Of course, we have a big test for Exxon as earnings roll out this week. But keep in mind right now, oil stocks, at least the bigger ones, Exxon, Chevron, outperforming the commodity because they happen to be value and dividend paying stocks. When yields go down, they appreciate just by the algorithmic nature of reactions. When we look at the 10-year yield, what do we see here? Breaking below 4.2. And it appears that we have more declines to come. Now, this one suggests that perhaps the Fed will indeed cut rates. The dollar says not so fast, so we'll see if this is going to be sorted out. Comes the FOMC, or will we see a different reaction where the dollar goes higher, but bond yields go down? And by the way, if that happens, rotation to the dumpster. Why? Because now we're buying bonds and the dollar, so we're freaking out. There's a panic. So you better hope that they're going to be back in synchrony, yields and the dollar. But most importantly, folks, what happens when we look at the ratio of the 2-year versus the 10? If the chart is trending down that you're looking at right now, the 10 is outperforming the 2. In other words, the 2-year is falling faster and deeper than the 10 because that's what the Fed can control, the 2, not the 10. Usually that's not good. The steepening of the yield curve, as we've talked about numerous times before, not good. Out of inversion, steepening out of inversion, not good for the equities market. Watch what happens when we plug in the NASDAQ, the NDX in orange. Every time we have a steepening of the yield curve, we see the NASDAQ stalling or moving down. And right now, it's the same thing happening. We have steepening of the yield curve and the NASDAQ going down, meaning the big caps are going down. In the meantime, with the yields going down without any recession scare, at least not for now, we see the home builders continuing to go higher, but not breaking above the previous high, 117.17. A little overbought, got it, but it depends on what happens with the FOMC. For this trade, they either continue to go higher or go down. My 2 cents would probably go down because I don't think the Fed is going to cut, even though I wish they would. But we'll see what happens. We'll look at the IYR real estate, a little weaker than the XHB because it is more sensitive and susceptible to the systemic risk. But still above 92.20, again, will be really sensitive to what happens with the FOMC and the reaction in the bond market. The same goes, of course, with the big one, the KRE. It's the big one in the IWM. It's the reason why the IWM been moving higher. Of course, the assumption is with rates going down, regional banks are out of the woods. But if the Fed says, hey, we're not cutting rates right away and we'll think about September, or we're cutting rates for the wrong reasons, I think the KRE rally will frizzle out. So we might have a lotto here, FOMC lotto play on the KRE. Then we'll look at the VIX volatility index. We talked about the possibility of an ABC pattern. We got it. We formed a topping candle Thursday. Friday, we pulled back. Is it the end of the pop in the VIX? I don't think so, because you look at the weekly chart for the VIX, and every time we've closed above the 20 weeks moving average, we've seen at least a couple of weeks, if not more, worth of a pop. So I think that we have more, and I think that will come the ideal scenario, at least for somebody who holds a bearish view in the market. Now we get a rebound Monday, Tuesday. Then comes tech earnings and the Fed pouring cold water, the Fed that is, on the rate cuts or cutting for the wrong reasons. And then we see technology earnings not doing so hot so. And we see the VIX popping higher again and the market taking a big leg down. You look at Big Kahuna Apple, what do we see here in the hourly chart? Consolidating right now within range, 220 is resistance, 214.24 is support. 2 cents, I think that Apple might weaken a little more before this report comes out. But again, you look at the weekly chart, and we're not even below the Fibonacci retracement in the weekly chart. We're not below 210.55. If we lose that before or after earnings, it's going to solidify the case that Apple might have topped, and maybe we got a little too excited with the AI promise from Apple. When we look at the souffle Tesla, what do we see here? We talked about the inverse ABC. We played that in the daily. Now the question is, do we rebound from here, close the gap above, or head down to close the gap below? I would say that we close the gap below and maybe overdo it and go all the way down to the 50 days moving average in blue, which is coinciding with the lower Bollinger Bands. Let's call it in or around 204 and then see what happens. Is there a bullish case for Tesla? Sure. If you look at the weekly chart, we can argue that maybe we're just pulling back in an ABC breakout. But then you think about the reasons of why we go higher, and you can't find any. The margin story is still bad in the company, and the promise of robotaxis not going to happen. It was a false promise again. So for now, the case is Tesla to the downside until proven otherwise. We look at NVIDIA, what do we have here? We lost 117, not good in the hourly chart. The question, of course, are we oversold? I think we are. We might have a retracement to 117. The problem in NVIDIA, though, whether we have a retracement to 117, which is, by the way, the bear advantage line. So if you cross above, the bears don't have the advantage, but doesn't mean that the bulls have the advantage. The bulls have the advantage once we close above 124.30. The problem with this stock, though, if you look at the weekly chart, we're sitting on top of the 20 weeks moving average support. And you look at the weekly MACD wave. There was an attempted correction before. Didn't happen. Is this one the real deal? And if it is, then the wave in the MACD is going down to zero, if not even breaching zero, meaning that the bull wave is over and now we have a bear wave. If that is the case, it ain't going to stop with the 20 weeks moving average, folks. You combine that with the IV rank sitting at the 70s right now, has plenty of room to go to the 100. And you put 2 and 2 together, if NVIDIA fails the rebound, let's say Monday, Tuesday, I think that we're going to breach the 20 weeks moving average. And we head down to the last support, which would be, by the way, about 30% plus worth of a correction. And lastly, what do we see here in Bitcoin tulips? The behavior of the chart is really important. And again, Bitcoin is a pulse on sentiment. And right now, the sentiment is pretty good because you have presidential candidates talking about don't sell your Bitcoins. I'm going to be friendly to Bitcoin. We'll have a national reserve. I think all of this is bullshit, but you see the reaction in the chart. Once it went down to 63,000 and it made a rebound, and then crossed above 67,000, that was a bullish confirmation. Now the next stop becomes 71,500, assuming we keep 67,000 as support. Here's the challenge though for Bitcoin, the weekly chart. Challenge number 1 was the 20 weeks moving average, where we've closed above 2 weeks in a row, so that's not a threat anymore. The next threat is the sloping line of resistance. If we stall there, catch a resistance and go down again, it would open the possibility for lower highs and lower lows, but one step at a time. For now, the daily looks pretty good. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? Monday, we got nothing. July 19th could be a good day for a rebound in the market, one that's going to stick a little bit at least to the end of the day. And then we have Tuesday, July 30. We get the Case-Shiller Home Price Index along with consumer confidence and job openings. Comes Wednesday, most important day, the 31st, before the end of the month. The ADP Employment Report, the Employment Cost Index on top of the Chicago Business Barometer. And after that, we have pending home sales, but the biggest event will be the FOMC and the press conference by Chairman Powell. Thursday, the 1st of August, we have initial jobless claims, productivity, then we have manufacturing PMI, comes with the ISM manufacturing reading, of course, and construction spending, with impact, of course, to the home builders and construction stocks. And lastly, Friday, the 2nd, we have the payrolls on top of factory orders. So macro will be front and center this week. From the FOMC to all of the data that we just talked about, but of course, the payrolls will be really important. I think the Fed's decision will have impacts on the expectations of the payroll. So if the Fed cuts rates right off the gate, the narrative will become, did the jobs report leak? Because Chairman Powell gets the report before everybody else. And are we cutting rates for the wrong reasons? If we don't cut rates, if the Fed comes out and says, hey, we're going to hold, did he get the payrolls? And did he see a hard number? Speculation will become an interesting game this week. So buckle up, folks. We have a lot to look forward to. But for now, this is all I got for you. If you enjoyed the show, please help us out by pressing the like button, subscribing, and leaving us a nice comment. And also consider joining us as a member to gain access to the daily coverage, Discord benefits, and bonus videos. But with that, folks, all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
This is not crazy. I mean, it's all very logical.
So now we pay out premiums on these swaps against
the housing market until the mortgages fail? In other words, we lose millions
until something that's never happened before happens?
That's correct.